Good morning, good afternoon, good evening, powerhouses. This is Dr. Dabaski. I'm here to give a short introductory video on Chapter 6, Inventory Accounting. Before we get started, I'd like to primarily point out that the inventory accounting is rather complex but straightforward at the same time, and there's little tricks of trying to learn this topic. So the first thing I'm going to do is I'm going to go ahead here and bring in a little Word document. I'm going to walk through this with you. So this again is going to be inventory for Chapter 6, and what I want to do is quickly give you a few acronyms on how we can deal with accounting. So how this is set up is the first column is inventory method, and we're going to either have LIFO, okay, and then we're going to have FIFO, okay. And we're going to call this first column the income statement effect. Okay. And this is going to be what we call the balance sheet effect. Okay. So the balance sheet effect and the income statement effect. And this is the two things that you need to learn about inventory accounting, is that there's going to always be an income statement effect, which by the way is going to be expressed through cost of goods sold expense, which is found on the income statement. And the balance sheet effect is going to deal with how we determine the ending inventory value, which is found on the balance sheet. So under these two methods, under LIFO, one of the acronyms you can remember is that where we start counting to determine our cost of goods sold expense, we always start with the last items purchased. So for cost of goods sold, we're going to use the acronym LIFO, last in, first out. We start at the bottom and work our way up towards the older purchases. So last in, first out for the income statement means we still have first in still here for the balance sheet, which is fish. Okay. For LIFO, again, we'll always use the acronym of the method we're using. So the cost of goods sold income statement effect will be first in, first out for the income statement. Cost of goods sold expense means last in, still here for the balance sheet, or LISH. Fish and lish. So for the income statement effect, LIFO, we start at our bottom, our most recent purchases, and work our way up to the older purchases. That leaves us what we have ending up in our inventory values at the end will be those from the older layers, or first in, still here, that are from the earlier purchase layers. So first in, still here. For FIFO, we start at the top, the older layers, and we work our way down for the cost of goods sold expense. And that means what we're left on the balance sheet, the ones that we price out for the balance sheet ending inventory, will be last in, still here, or LISH. So LIFO fish, FIFO LISH. Conceptual points for LIFO is that this is, we're going to assume rising prices. So it will give us higher cost of goods sold expense and lower net income, and therefore we pay less taxes. This is why companies use it. It also means that since fish, first in, still here, it gives us older, more stale balance sheet values. For FIFO, first in, first out, we're going to assume rising prices as well, which means that it's going to give us, because first in, first out are the older layers, lower cost of goods sold expense and lower cost of goods sold, expense, and higher net income. And that means we're going to pay and more taxes. So the good news is that our balance sheet, last in, still here, our ending inventory, apologize for this headphone keep falling off, the ending inventory reflects current values. So it's desirable from a balance sheet perspective, FIFO is, but LIFO is desirable from an income statement view because it gives us a better matching of our expenses to our revenues. So this is a short, little, very small introduction to LIFO and FIFO. One way you can remember of where do you start when you start costing out your inventory. There will be another example on this that will come that I will post as well that will follow this video. So I'm going to include all of this onto one video because it's all related to one So now we're going to continue this topic by looking at examples for LIFO and FIFO. So inventory versus cost of goods sold. So the first thing we want to know about inventory is that cost of goods sold represents the inventory that's not yet sold, where the cost of goods sold represents the cost of the goods that actually have been sold. So let's look at an example. This is a very important calculation. You should know how to calculate cost of goods sold. So one way to do this is to know that we take our beginning inventory and we add our purchases and we subtract our ending inventory, and that's how we get our cost of goods sold. So beginning inventory plus our purchases is cost of goods, how much inventory we have available to sell, less what's left or that's unsold would give us what has actually been sold, or 48,000. Notice what's not sold and sold adds up to what's available to sell for the period. That's your check and balance. I do have an acronym, kind of a silly one for this, which I call BIP minus EIEIO. BIP stands for beginning inventory plus purchases. There's your BIP. Add that together, you get your goods available. And then minus EIEIO, your ending inventory, then you get your COGS. So this is how we measure cost of goods sold. BIP minus EIEIO. So the cost flow assumptions, let's suppose a company has 3 units of inventory. A is 20, B is 24, and C is 34, purchased in that order. If the company sells unit B, what is the cost of goods sold? Think about that for a second. Well, some of you would say 24. Well, that is what 24 cost, but it really does depend on what method we are using. Companies under US GAAP, under the accounting rules, are allowed to determine which good was sold. Pretty interesting accounting, isn't it? So under first in, first out, or they can use last in, first out, or they can use the average cost method. In the above example, if they were using FIFO, they would then say the first in, first out would be A, or 20. Under last in, first out, they would have to cost out it whatever they paid on the last purchase, which was C, 34. And under average cost, they would take an average over all three, the 20 to 24 and the 34, divided by 3, or 26. So let's look at an example of a cost flow assumption. Let's look at our cost of goods sold, or get our cost of goods available for sale. Beginning inventory, 20 at 2. We purchased 30 units, sold 40 units, purchased 50 units, sold 30 units. Can we compute the cost of goods sold and ending inventory after these events? Again, put together the BIP minus EIEIO. Your beginning inventory was the 20 at the 4. So let's look again using our FIFO method. Now we're going to go through this one method at a time. So again, here's how the method is. First in, first out for the income statement. Means last in, still here for the balance sheet. So what's the inventory available for sale? 20 at 2. We have our purchase layers, right? So we have 100 units available for sale. And we're going to take the first 70 that were sold, because remember we sold 70 units, 40 and 30. So we're going to go ahead and cost those out. We're going to start at the top. First in, first out for income statement. Inventory sold is the income statement effect. 30. And 20 would come out of the January 4th layer, which would mean the other 30 would be unsold and go on the balance sheet. So the first 70 sold means the last 30 not sold will end up on the balance sheet. Our cost of goods sold, if you foot this across, 20 times 2 plus 30 times 3 plus 20 times 4 is 210. And then our inventory that's unsold will be 120. This is an example of how you would cost out inventory, and you will get an example of doing this in homework. An example in LIFO, remember last in, first out, means first in, still here for the balance sheet. So we'll take the same data points. What's our inventory available for sale? Well, it hasn't changed from the other example. We still have 100 units available, except this time we're going to start down here and we're going to work our way up. We're going to take the last 70 sold. So we're going to go ahead and send these 50 to the income statement as cost of goods sold. We're going to need 20 more because remember we sold 70. We have to cost out 70, which means 10 would be unsold from the January 2nd layer. And then that means these, since we've already costed out everything, all of these last layers, first in, still here, would all go on the balance sheet for the ending inventory values. Again, the last 70 sold leads on the balance sheet the first 30 that are not sold. So using my little chart, last in, first out, we start at the bottom, last purchase, work our way up, cost out what you sold. Whatever you haven't sold goes in the not sold, which means first in, still here, or fish. We can go ahead and calculate this out, get our values. Now for average cost, this is the simplest method. What we do is we take our available goods for sale. We have 100 available, divided into the total cost, extended out the red numbers. You get $330 per unit. Use this same number for the units that you sold and for the units that are unsold. So therefore that would give us the cost of goods sold of $231 and inventory of $99. Summary of these methods would be, sales would be the same for all methods. Cost of goods sold would be, as we said, higher for cost of goods sold, lowest for FIFO, and the average falls into between the two. Gross profit, which is sales minus cost of goods sold expense, would be highest under FIFO, as we would expect because lower cost of goods sold, lower under LIFO because of a higher cost of goods sold, and in the middle for the average cost method. So we know that the reported revenue is the same under all assumptions. Cost of goods sold differs across the assumptions. We call this the income statement effect because cost of goods sold is an expense and it goes on the income statement. And the ending inventory also differs across all of the assumptions, and we call that the balance sheet effect because the inventory appears on the balance sheet. So which assumption is best? Well, if inventory costs are rising, FIFO produces higher net income and higher total assets. If inventory costs are falling, LIFO produces higher net income and higher total asset values. Notice that's if the costs are falling. We know that FIFO is a balance sheet focus because it better measures the value of assets at their current replacement cost, and the amount reported for inventory asset is most current. The LIFO is an income statement focus which gives a better matching of current revenues with current expenses of inventory. And then therefore the amount reported as cost of goods sold expense is based on recent inventory prices. Recall that LIFO results in lower net income if costs are rising. However, if costs are falling, look up to bullet point 2 here, LIFO produces higher net income. Okay, so we have to be careful with LIFO. But generally during rising prices, LIFO will give us lower net income if costs are rising. Lower net income allows the company to pay fewer taxes to the IRS, and this is the main reason why companies use LIFO is to pay less taxes. And then there is a rule that says if LIFO is used for tax purposes, the IRS requires that the companies also must use it for financial reporting purposes. Because think about it. The company would want to lower its tax bill, pay less taxes, like we all would want to do. But then it would also want to show its investors higher profits, so it might be inclined to use FIFO. But the IRS says you can't do that. If you use LIFO for tax purposes, you must use it for financial reporting purposes as well. That's also known as the LIFO conformity rule for tax purposes. Well, that was a quick review of the 3 inventory methods. However, that would give you very good detailed examples. Please review this and practice your homework and know where to start your counting of your inventory. Look at my little chart and my acronyms and pick a method that works best for you. Always believe in yourselves. This is doable. Hang in there. It's going to be over soon. You're doing a great job. Great work.